dialed in to the Retirement Income Source here on 590 AM. This show is sponsored by Sparks Financial Group, a financial firm right here in the heart of the Bluegrass, Lexington, Kentucky. I'm Tim Sparks, your host, and today we're going to be talking primarily about why 5% is better than 8%. Now, you may be thinking, why would 5% be better than 8%? Duh, I'd rather have 8 any old day than 5. After all, we're talking about my money here, Mr. Sparks. Well, that's true. I mean, when I say 5% and 8%, there is a distinct difference. You see, we're talking about going forward. And when you're going forward, there's only one of those returns that more than likely, reliably, is going to occur, and that is the 5%. Now, think about what I just said and let that and swallow that. Because 5% on $1 million is $50,000. That's because I'm using the formula total return equals income plus growth, or interest and dividends plus growth. All investments out there have I and they have G combined that makes up a certain return on a given year. But 5% is better for someone that's going into retirement or already in retirement, or you're 5 years from retirement, or you may be a little slightly conservative and you're looking for a way to conservatively or moderately earn a return that you know is reliable going forward. Keep in mind, going forward, there's only one of those that you can count on. That is the 5, not the 8. What I'm talking about is most people are convinced that they can make 8% on their money in the long run. Heck, why not go for 10? Why not go for 12? But you know, in the last 10 years, I'm willing to bet that the markets have averaged more than 8% a year. I'm willing to bet if I was to pull up mutual funds, you know, we're all guilty of this. In our 401ks, we have a tendency to always choose the higher performing funds to put our money into. And then when we're 20, 30, or 35, or 40, 45, or 50 years old, that makes sense. There's nothing wrong with having funds that may have averaged 10 years, because that's usually the longest period that they usually show. You know what I'm talking about, year to date, 1 year, 3 year, 5 year, and 10 year. Well, if 10-year returns could have been 18%, could have been 19.5% or 23%. I really don't know. It depends on the type of fund that you're actually looking at. But you got to keep in mind that when you're investing for retirement and for the purpose of income, you got to have something more reliable, something that you can depend on to pay the bills. And so if that's the case, and I've substantiated that you're in retirement, you need income, do you want that income coming from reliable return or from an unreliable return, a hope and a prayer return? We see the 8 is a hope and prayer. Because when we do retirement risk reviews with clients that call in from the radio show wanting to know the distinct difference, it really blows their mind how they can earn a 5 residually every year and they'd be more dependable, more reliable than, which I call more of the bird in the hand approach, than to focus on the 2 in the bush approach, which is the 8%. Because 8% really is a focus on growth and growth alone. Because you got to hold your money for a certain length of time to get an 8% average return. That not only that, if you're going to invest for 8% or 10 or 12 or whatever you're thinking that you need to make in returns, or what you read about or whatever, and you will make it over time, the word over time means you need to hold on to that investment. That's not an investment where you draw from and take income from. You want if you're looking for income, then you need to be more intentional from a perspective of where that money's coming from. Worst thing you can do, the most cancerous strategy you can do when you go into retirement, is to actually withdraw your money, call it income, and when in theory all you're doing is selling shares. And see, you can focus on 8%, but it doesn't mean you're going to be earning a net 8% if you're taking income from that particular portfolio. Why? Because withdrawals work differently whenever you're taking, or returns work differently whenever you're taking out income from your investment strategies. Matter of fact, it's a profound difference because, at the end of the day, if I need to take out, 5%, $50,000, then why in the world would I want to choose a strategy where I have to sell shares to do that? It doesn't make sense to me. Matter of fact, I will pay to get that kind of return because that is although it's a return on the money, it also reduces risk. And after all, most of us want to reduce risk. We want the least risk for the maximum return. You do that by focusing on 5%, and that's why we believe 5% is better than 8. 8 is a hope and a prayer like type portfolio. You're crossing your fingers and crossing your toes and hoping that you make 8%. You may do it, or the investments that you're in may do it. Believe it or not, the average returns does work, but as soon as you start taking withdrawal, the math works differently. Did you know between 2000 and 2023, the average return right now, and I'm sitting here looking at the average S&P index return. This is VOO ETF, one of the best ETFs out there for the S&P that mirrors the S&P 500, was just under 6%. Now think about that for a moment. That's not really a great return and taking a lot of risk just to get 5.74%. But if I was earning 5% from the I don't have to worry about averaging a return at all in theory, right? Because what happens is most people think they got to average a higher return, and you're right, you do. Matter of fact, 8 is not good enough for me. If I'm going to stick my money in a volatile instrument, I'm going to be hoping that I average 15 or 20% in order to do that. Because why? Because it doesn't really matter. I'm still having to sell shares. And so in the long run, I do know, being a student of market history, that the markets are very volatile, very choppy. And right now, how do you like what's going on right now? The market, again, is starting to come down again. Why is that? Because the things are getting to be overpriced. Inflation hasn't ran away, and long-term 10-year T-bills are going back up again. So if they go back up, that means you're going to have volatility. So if this makes sense to you, in other words, you're wanting to know, how in the world can I get 5? And you're saying 5 is better than 8, but I knew the income. I mean, where'd I get 5%? Well, there's instruments out there that are in market-based instruments that you can get 5%. And there is a report I want to get in your hands, a commission report, and it's based on the financial strategies. In other words, what instruments actually will pay that. And you can get that report by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you or email it, whichever you prefer. Again, these are financial strategies or instruments, asset classes that pays in excess of 5% a year on the average. What our clients are getting, so that way you don't have to worry about the maybe type of retirement. Keep in mind, you're trying to preserve your principal. This is the way you do it, the right way, the old-fashioned way. People that utilizes these strategies are people like Warren Buffett. And again, 888-930-1080, you can have his report. I'm Tim Sparks, and today we're talking about why 5% is still better than 8%. Keep in mind, we are talking about going forward. And I know that I say this a lot, and for some of you, this may be a repeat like type show to some degree, but repetition is where we learn. And what I have learned about market investments is they fluctuate. They're fluctuating right now. I don't know about you, but you're looking at your statement. Some days it goes up, some days it goes down. But every day it's a stressful situation for anybody to look at their statement and hope and pray that the markets will continue to cooperate. Well, I hate to tell you, as long as you're choosing to be in the market, Keep in mind, it's not your financial advisor. They use the instruments, but you're part of the choice. You're part of the decision. You hired them for that reason, to help you to get through the markets, help you to understand that the markets are tipsy-turvy, and you're going to be able to, and you have to take income, and they're telling you they can help you do that by utilizing an average return of 8% to do that. And that's great. The investment strategy that you have may get 8%. But at the end of the day, if you're taking out 5%, then you may have a few years or maybe a down year. And you're having to spend money because you're not getting any kind of return. And you're taking out equivalent to 5%. That's what your target is for the year. $50,000 on $1 million, people, is $4,000 a month coming out of that account. That's roughly $50,000 a year. Where do you want that money to come from? I don't know about you. I'd rather be earning in residual interest. And we actually show people how they can actually do that. If you're with Fidelity has a single page. It will tell you. This is blows people's mind when they see this. When they bring in a statement, they have all their investments with Fidelity, and I'll turn the page around. I said, see right here, for the next 12 months, even Fidelity know this, but you're not looking for this. You look at the bottom line. You don't look at how much income and where's it coming from, but you should be if you're especially trying to preserve your principal the right way. And so this page is it will tell you how much income you're getting. Matter of fact, the retirement risk report that we actually offer on this show will help you to assess how much income you're really getting, which is extremely important because 5% will be better than 8%. Why? Because you now don't run a risk of running out of money. But if you would like to learn more about income first methods, in other words, income first, growth second. If you get income, you focus on the 5% first. That's the extra return that nobody's actually investing for today. Then I want you to get my book, The Retirement Income Shift. This was Amazon bestseller and still is Amazon bestseller, 4th month in a row. And it's a great book, and it will help you to understand why income is extremely important and investing for income the old-fashioned way when you're in retirement. And this book is available for the first 5 callers of today's retirement income source. Call 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. We will be back in a jiffy. Welcome to the Retirement Income Source. This is Tim Sparks, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. Today, we are talking about why 5% is better than 8%, especially if you're fixing to go into retirement or already in retirement, and you want to make sure that your retirement ends well. Keep in mind, retirement is about not just spending income, but also preserving as much money as you got now throughout your retirement, because what you're doing is you're using those retirement assets to generate income. That should be the number one goal. And if you focus on generating income first, then you will get growth as well. But see, most people, unfortunately, are spending their principal because they're not getting 5% from their income side of their component. I mean, think about this for a moment. In the next 12 months, you got $2 million portfolios, okay? And they both equally are invested in the stock market. One of them is made up of stock funds or stock ETFs. It doesn't really matter. Good quality. Let's just say they're all 5-star. You know what I'm talking about. Everybody says, oh, Morningstar rates them 5-star. I'm in the best. Well, the best may be okay until you listen to what I'm fixing to say. If you have $1 million in that vehicle and you're not paying a financial advisor, you're going to get about $15,000 a year. In other words, that's what you can expect to spend right out of the gate. In the next 12 months, that's $1,250 a month and $100 bills practically. Now think about that for a moment. Imagine a stack, $15,000. It's going to be paid to you over the next 12 months, no matter what the markets do. Okay, you're in the stock market. You're in a great quality S&P index fund. Okay, and you're only going to get $15,000 a year. Or you can be equally in the stock market on an individual stocks and get $40,000 a year. That stack of $40,000 in $100 bills is bigger than the $15,000 bills, right? Well, think about it for a moment. In the next 12 months, which one of those stacks, if you're in the stock market, you're invested in the stock market, and you don't want to touch principal, which one of those stacks makes more sense? The $40,000 stack every time. Why? Because you need income too. But let's just say you don't need income. Well, $15,000, let's just say you're not spending your money, you're in retirement, you're not contributing to this plan. Well, the $15,000 that's coming from the S&P index fund, reinvest and buys $15,000 worth of new shares. But the other stack, the $1 million that's invested in individual stocks, is reinvesting $40,000 in new shares. Which one of those stacks are more than likely, over the next 10 years, going to outperform the other? Which one of those stacks? I'm willing to bet a $100 bill that the $40,000 stack for next 10 years, at $400,000 getting reinvested, is going to build that stock portfolio, because all it's doing is reinvesting, is buying more and more shares, is going to outperform the one that's only generating $15,000 a year for the next 10 years. I'm just doing the math in my head. It'll be illogical here. That's $150,000 being reinvested. I mean, $250,000 more invested in good quality companies. And by the way, people, not all stocks that pay dividends are good companies that will actually give you growth too. I was talking to our analyst the other day, and I'd asked him particular about a couple companies. Now, I'm not going to mention the names, very well-known companies. I'll go ahead and at least mention the name, but I'm not going to say a lot about it. It's Pepsi-Cola. Everybody knows about Pepsi-Cola. It's a dividend-paying company. I mean, and if I'm just an amateur guy, and I say amateur being, me and you and everybody that's listening to this radio show, everybody's investing money. They're not analysts. They just go out and they pick stocks. This is one company that probably would make my list. So I asked our analyst, and by the way, our analyst has averaged pretty significantly much higher return, equivalent or similar to that of the S&P 500 for our clients, since we've actually been working with him, and he's done it with a much higher dividend. But that is not easy, because even though they're imperfect, there's always going to be companies sometimes that don't always fit the bill. But keep in mind, I asked him, I said, this company, if I was picking this company and I'm sitting there thinking, hey, why not? I've seen people come in, they have this particular stock. He says, well, this company in the last 5 years really hasn't showed a really good return, even though the dividend has not done very well. And oh, by the way, they're not that profitable. They've lost about 25% in the last several months. How much did I know of that? I didn't know anything about that. But when you're talking to a stock analyst, that's all they focus on. Just like you work, wherever you work at, I'm willing to bet you know more about your job than I do. And if you did a radio show, just like I'm doing a radio show talking about this, and if you were one of those type of people just wanting to shoot people straight, you can probably tell everything you know about your job probably within 20, 30 minutes, like second nature, like driving home every day. It's like wherever you're going. I mean, when you go back home, it's like second nature. Nobody will even have to give you these directions. Well, it's the same way it is whenever this guy blurted out the information I need to know about a company, Pepsi-Cola. Now, the reason I'm bringing that up is there's nothing wrong with the company. I'm sure the company will actually get things changed for the better. But now I understand why I got to have an analyst. I can't sit here and guess. And that's what most people do whenever they're investing their money in the stock market. They're doing a lot of guessing. Although the company will pay the dividend, when I'm in the stock market, I want growth too. I don't want just income. But there's years you're only going to get income and no growth at all. Matter of fact, you may experience losses because, see, the dividends are paid on a per share basis. The share is ownership. That's what you own. And every time you get a dividend, that share can fluctuate. That's what fluctuates on paper. But the dividend is reliable. It's going to be paid to you. Matter of fact, dividends will actually increase over time, anywhere between 0 to 5% on a given year basis, especially if you're picking the right companies. But there is a science to it. Knowing the difference between too mature of a company and companies that are entering into the market of value stocks, we call them dividend paying stocks. There's a lot of research that goes into those because typically we only invest in about 30 to 35 companies in our client's portfolio. That's all you can really invest in. Anytime you get past that, you got to put a Superman on your shirt to be very good at it. And if an analyst is really good at something, they don't need to have a Superman on the shirt. They can focus on 30, 35. You can have few and get a lot, or you can have many and get less. And so that's why it's so important to have the right companies in your portfolio. That way you get income and growth. And if growth doesn't occur, it doesn't matter. You still get income and loss. That's the way the stock market is. If you're wanting to get inflation adjusted returns over time, you will be fine. Focus on the dividend first. But I got a commission report I want to recommend about stock paying dividends and what that means. So I'd like to get that in your hand. We can mail it or email it, whichever you prefer, by calling 888-930-1080. Again, that's 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we're talking about why 5% is still better than 8%. Why? Because we're talking about going forward, and most people that are listening to our radio show are actually needing income on a month-by-month basis going forward, not going backwards. If we went backwards and we're trying to get a return on our money, how many of us are geniuses when we look at the market and where we should have had our money? Every one of us are geniuses if we want to spend any time in the financial sector of finding out what's going on in the markets. I could have had this particular fund or that particular fund. And if I'd just been there 5 months ago or 10 months ago or 2 years ago, I would have this much money. That's true. But hindsight's always 20/20. All we can do, what we got to realize is foresight is really 20/20. It's all about going forward. And since you don't know and I don't know, you got to realize where you invest your money is, especially when it comes from a reliable return, focus on the dividend first. Then, and if you can live on the dividend that's been paid to you, you'll be fine. But what I find is most people cannot stomach the volatility of the stock markets, and they get in and they get out. They get in and they get out. It's an emotional thing. Think about it. We're all guilty of this. When the markets have a tendency to go up, we really don't want to sell yet because that's our greed stepping in, right? I think I can make a little bit more. And so, and when we're looking in the rear view mirror in the short-term distance, right now in the last couple of years, the markets are up like 20-something% and 30 or 40% for 2 years in a row. That's pretty good. But every time you have two big returns like that, what that tell you probably coming ahead, more than likely, things are going to start shifting. If you're not ready for it, guess what? You're going to take a hit. And then now you're going to be on the flip side, wishing and regretting that you didn't sell whenever you were up. You got to keep in mind, people, the only way you can have your cake and eat it too is to be able to have dividend paying stocks. Find you somebody that focuses on that, and not only focuses on that, but they have good top-notch analysts that's all they do is they specialize in that. Anybody specializes in anything is going to do a lot better than somebody that as an average Joe. And most average Joes are most financial advisors. They've got nothing to do with their knowledge of the industry. It has everything to do with where you should have your money. And that is a different specificity. That requires a certain specialist to get you that type of return and income at the same time. So I got a great book, Income First, Grow Second Methods, The Retirement Income Shift, written by your host, Tim Sparks. Amazon bestseller now, 4 months, since October 22nd. First week after its release, already hit #1 on Amazon. Great, excellent book, great read, very understandable. And I got a free copy for the first 5 callers of today's Retirement Income Show. We're calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. We'll be right back. Welcome to the Retirement Income Source. This is Tim Sparks, your host. And today we are talking about why 5% is better than 8%. And why 5% should be your focus, especially whenever you're either going into retirement or thinking about retirement really soon and you're trying to protect what you have, or you're already in retirement and you want to make sure you get the most mileage out of your money. Why? Because 5% will get you more mileage than focusing on the 8th. You see, 8% is focusing on growth, and it's focusing on an average return. And an average return over time in any kind of fund you pick that's a stock fund typically should average 8%. But as soon as you start taking withdrawals, the math changes dramatically. Because now it's all about the fluctuation of the return itself on a day-by-day basis. On a day-by-day basis, now we're getting more specific. Now we're getting more in the short term of things, not the long term. Well, in order to have a long-term consequence in a positive way, we got to focus on the 5% first. You get that by focusing on income first. It's very difficult to do that when you're climbing, because all you're doing is you're climbing an uphill and it's actually working against you, people. And you got the wind in your face. Imagine going downhill with the wind at your back. That's what we all want. But most people, when they go in retirement, you're talking about going forward, and nobody knows what's going to happen going forward. And so the only way you can get income from an investment, of course, you can take money from any investment. If it's losing money, you can take money from it and even spend it. I mean, how many of us have sold our house and had extra equity from it? You know, maybe after we sold our house and paid cash for the other house, and we wound up spending it. Well, we all know that probably wasn't a prudent thing to do, but some people actually do that. But believe it or not, when you're talking about retirement investments, the whole goal is to leverage all those instruments, including that equity. But see, most people don't realize that they're spending their principal, and they're hoping to recover it on a month-by-month basis. That is very hard to do. I mean, look what the markets are doing again. I mean, for the last 2 years, the markets have done pretty good. You know, the returns are for the S&P 500 or the NASDAQ, no matter whichever index you're tracking, is up pretty strong. In 2024, I'm sitting here looking at the figures right now. The S&P was up 23.3%, the NASDAQ grew 28.6%, and the Dow grew by 13%. I mean, if I'd had my money in any of those 3 instruments, I would have done okay. But when you start taking withdrawals from even those instruments, you're selling shares. You can't spend growth. Because, see, those instruments don't pay much income. Their focus on those are growth. That's just like your house going up in value 23%. If you have a house that's worth $200,000, it goes up 23%. Now what's our house worth? Roughly $250,000. Well, in order to get that $50,000, you got to sell the house. That's the same way here. And what happens with growth? You can actually lose growth. You can lose that $50,000. That $250,000 house can drop to a $180,000 house. It's the same way it is here. So you want to do what a landlord would do in that analogy, and take income from and put a renter in that property. And then over time, the value of the house in of itself will go up or in a consistent way, or in an inconsistent way, I should say, like a jagged sawtooth going up straight up the hill. And by the time you get to the 10th or 20th year, it's going to be double or triple the value. But what did you do along the way? You also were getting income from it. Even if you lost a renter or two, it doesn't really matter. You were much further ahead. You see, there's risk in anything, right? But, think about it for a moment. People are already starting in the hole every year, just practically, because they're taking withdrawals from their principal. That's starting in the hole. That means you got to recover that. Plus, if you're being charged a fee, you got to recover that as well. That's two things you got to recover and take income, which is the positive thing out of your portfolio, whether it drops in value, goes up in value, or stays stagnant in value. Always remember, in the TR equals I plus G. This is the formula that's been utilized in those instruments. You may not know that that's going on, but I'm giving you the formula right now. This is this. You want to call it a secret? You can call it whatever you want to. The I plus G, interest and dividends plus growth. In other words, there's two ways you make a return on your money. But only one of those two ways is a positive return every 12 months. And that is the I. The I was always a positive return. You got to keep in mind, interest and dividends are going to be paid to you regardless. Now, think about what I just said. It's going to be paid to you regardless. In other words, I'm going to get income regardless of market performance. And so that's why the I is the focus, at least it is with the advice we give to our clients. But it goes beyond that. I mean, we gotta have the right vehicles. That's the reason why we decided we're going to hire analysts. We're going to put people, that's all they do. They focus on, just like a heart specialist that focuses on, a heart surgeon, for example, focuses on heart surgery. I'm sure you want somebody that's been doing it for a long time and has a lot of success, not somebody that does not. And you don't want your general practitioner doing that because it requires a certain specialization. But keep in mind, growth comes in two ways. Capital appreciation, follow what I'm saying here, requires time. You buy something, you buy a house, it doesn't go up in value immediately. Sometimes if you bought it undervalued in the first place, but most times, there was a flipper-like type properties, but most time you have to wait. And then the instantaneous return that you get is the rent or the interest or dividend. Those are the things that's going to be paid to you regardless of what whether you get capital appreciation or depreciation from that particular instrument. If you would like to know more about, in other words, how in the world can I get 5? You've got me convinced the 8% doesn't make sense. Not only that, if I'm getting 5, I only need to get 3 from the capital appreciation side of the instruments anyway, in order to still average 8. As a matter of fact, you probably got a leg up on somebody that's averaging 8. It's only got 1.5% coming in versus 5% coming in. So that being said, I want to introduce you to the retirement risk report. It's something we do for people that call in on the radio. It's a free report offered to anybody on this radio that's listening to this show today. And you can get this report. It starts with a phone call with myself by calling 888-930-1080. Again, that's 888-930-1080. And it will start with a phone call. Well, in that phone call, to be productive, we need to have certain information in order to get that underway. So that way you can find out whether you are getting a 5 or if you're getting less than that. Keep in mind, preparing for retirement, you want to biggie size your income. And what the retirement risk report does, it's a simple one-page proprietary report that we use that actually helps you to know and understand what income you're getting now and how much income you are leaving on the table. That's the most important part. Also, you may be wondering, am I paying the right amount of taxes, or am I going to be paying too much in taxes when I go into retirement? Sometimes a Roth conversion could make sense for some people. We have a way of being able to define that, or whether it makes sense or not. Not just flippantly telling you just to do a raw conversion to gain your business, but it has to make sense to whether raw conversion is the right way to go. Also, are you using contractual instruments or non-contractual instruments to generate that income? In other words, if you're trying to reduce your risk, a better way of doing that is using contractual instruments. You see, corporate bonds are contractual. They got two sets of guarantees. They're going to pay you income, plus they're going to give you a return of your principal back. Kind of sounds like a CD, right? Well, it's kind of, but it's not FDIC insured, and of course it's not a CD. But a corporate bond, kind of similar in a similar way, except it has more volatility, but also you're going to get more risk or more return on it, and you're going to get it paid to you a lot longer. And so that's the reason why people invest in bonds. That's the reason why insurance companies invest in corporate bonds, because they need something to rely on, because they're required to keep their risk reduced in their own portfolios for all of the benefits that they offer. So they use corporate bonds. And also, how much in fees are you paying? You know, there's good fees and there's bad fees, right? Good fees is think about it more. If you got $1 million and you're paying a financial advisor $12,000 a year, $12,500. That's 1.25%. That's kind of about the average what I see today. But you're only getting 18 or 20,000 in dividends. Well, what's happening is they're getting 12,000 and you're getting about 8,000, but yet you're needing to spend 40,000, which means you're going to have to spend principal. You can determine whether you think it's a good fee or a bad fee. I think it's a bad fee. Why? Because you're giving up more of your income, part of that portfolio, which is forcing you to spend more of your principal. I wouldn't pay a fee for that. Matter of fact, it's so easy, a caveman can actually invest in stock-based mutual funds. I'm going to tell you all this much. This is not rocket science, putting money in stock-based mutual funds. They're very easy to do. It doesn't require a mental heavyweight to be able to do this. But most people don't realize that. They say, oh, I got to have an advisor do that. Well, you're really kind of giving up some of your return to do that. And so a good fee would be, what if you're paying $10,000 on that $1 million, and I'm using an arbitrary number, but yet you're netting $50,000 a year, and you only need $40,000. Well, that's a good fee. Why is that? Because you're not having to spend any principal. So at the end of the day, what is one doing than the other? Well, it's all about protecting your principal. You're trying to protect, just like a landlord's trying to protect the rental property. They want to get the property rented so that way they can collect their income. They live off their income. They hold the asset. That's exactly what you should be doing too. That's what you pay for. We get sometimes what we pay for, right? And, fees are always an issue in the absence of value. So that's the retirement risk report, and that's what it encompasses. And we cover all that in that particular appointment. So with that being said, if you would like to know more about income first methods, in other words, what do I mean by income first methods, growth second, I want to get an excellent book in your hand, How to Get the Extra 5%, through my book, The Retirement Income Shift. And this book was actually just now actually came out in October. It's been number one at Amazon in 4 areas of personal finance. Even till today, I just got the report in by my email just a little while ago, still number 1 in 4 categories. And this book can be yours if you're one of the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source. Tim Sparks. I'll be right back. Welcome Welcome back to the Retirement Income Source. This is Tim Sparks, your host, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. And today we're talking about why 5% is still better than 8%. Keep in mind, when you're picking any instruments and they're stock-based instruments, most of them will probably average 8%. So that's what I mean. 5% is better than 8. 8, I'm talking about, is based on an average return. And keep in mind, we have to say average. Anybody that's in the financial world like myself, a financial advisor, said, well, we all can get you 8%. And most of us can agree that's probably a true statement. But 5%, believe it or not, is still better than 8. Why? Because 5% of it is more of a definitive return. It's reliable. It's the return that you can expect in the next 12 months, in the next 10 years, in the next 20 years. It's got a track record. It can be also contractually guaranteed based on the paying claims of the companies and based on the default. There's no default. And I'm talking about corporate bonds. I'm talking about preferreds and instruments like that can pay you 5% and return your money. Over time, your balance will be fine. It's going to fluctuate on paper. Doesn't really matter. It's just a paper loss or a paper gain. You're still getting 5%. So you'll see, think about it for a moment. You need income. So we're going to spend the next few minutes in the latter part of the show going over some recent people that we spoke with about 5% and why it was better than 8. I had a couple come in. They had about $900,000 in their portfolio, and they very respectable firm. Matter of fact, this advisor they had been with for quite a long time, and the reason they were utilizing this advisor happened to be going to their church. In other words, this is somebody that they knew, and of course, me being a financial advisor myself, when I know that, if I'm working with somebody and there's somebody that's close to me or something like that, or if it's a client that we're working with, and we've been with them for a long time, a lot of times people don't like to part ways. They don't like to make changes too much. And so I'm very cognizant of that. I was cognizant of that in this meeting. Well, what happened is we sent them our information. We offer a book on this show. And that's what we do. We suggest people read the information before we start having conversation. Why? Because it's going to help you to understand it more. Now, there's people that will actually call in on a radio, listen to my radio show for the last 5 years. And will eventually, I don't know whether it's just a matter of timing or whatever, they finally call our office or schedule an appointment through you can go to our website or www.sparksfg.com and actually schedule that appointment because it automatically accesses my calendar online. Some people prefer that. Whatever it is, they will schedule that appointment. But this particular couple, going back to this couple, they were needing maximum income. They've heard me on the radio and they want to know, are they doing the right thing or should they make a change? Well, I'm not here to try to change people's relationship with their advisor. It has to make sense whether they want to make that change with choosing our firm. Because I get it. I've got to earn the trust that this particular advisor had already earned. So I just pulled out the retirement risk report. And that's pretty much how we do every appointment today. And I'm never going to change. Why? Because it's an eye-opener. It's a lot simpler to understand. It's proprietary. It's a tool we decided to use for the retirement income source. And people like simple. And so it really helps them to be able to assess their current income. Not only that, it also lets them know, do they have any contractual instruments? Keep in mind, we're trying to reduce our risk. And risk is another important factor. It's not risk of losing money or risk of gaining money, right? Because that's why we take risk. A lot of it has to do is some people wants to have peace of mind that their balances are not fluctuating because they don't have peace of mind when their balances lose 10%. They got $1 million, it's down to $800,000. I want to make sure that we get that out right out of the gate, not talk about it later after it already happens. So that way they wasn't shell shock because I'll keep track of my notes and I'll bring that up. And I say, okay, you told me at one time you were comfortable. Now all of a sudden you're telling me you're not. I want to know that up front. So it's important to be able to have that set up. So at the end of the day, this couple was getting about $8,000 net to them after all their fees and everything. This report uncovers all of this. And they can get about $41,000 and some change. I don't know about you. I'd rather have $41,000 coming in than $8,000 when I need $30,000 to $35,000 in spendable income going into retirement. And that's pretty much their goal. And that's what this report did. It helped them to see what they were paying in fees, how much risk they were taking. They can, this particular portfolio can lose up almost $400,000. That was unacceptable. And so this report helps you to see all that. Imagine seeing the risk of loss that you can see in a given year or in a given 3 to 5 years. And so there's a way of stress testing it through this report. And at the same time, knowing how much income you got coming in, because your income, if your plan B is only $8,000, that's not enough. And you need more income than that. So you're going to have to reduce your risk or go into more conservative like instruments to be able to avoid that type of loss. And do that, you also got to have bond and bond-like instruments that also would generate the yield you need to be able to provide you the kind of income you need. So if you would want to know more about how to get a retirement risk report, which is what I'm talking about with this particular couple, who was taking more risk than they needed. They want to reduce the risk and at the same time be able to increase their income. There's ways of doing that. This risk report helps you to do that by calling 888-930-1080. Again, that's 888-930-1080. And we will mail this or email this to you. We got a retirement risk report, commission report we can send you. If you want to know more about it prior, or you can schedule that appointment with myself at 888-930-1080, and we will help you to assess where you're currently at. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we're talking about when 5% is better than 8. 8 is an average. It's a goal. It's a long-term goal. We all want them. But meanwhile, we got to have something to cover the income, which is on a day-by-day basis. Think about it. Every day you wake up, S&P's up, S&P's down. That's the way it is. If you're going to be able to, if you're okay with stomaching volatility, the question is how much income are you going to get? Some years you win, some years you lose. And at the end of the day, when you're losing, are you going to be comfortable still taking income from that type of instrument? Most of the people we work with do not want that type of strategy because at the end of the day, they want to have a stress-free retirement. So I got one more client issue here that I want to bring to your attention. It was somebody that I met with that actually very similar. It was a couple, and they had $800,000, and they were getting about $11,000 a year in interest and dividends. They were pretty much doing everything on their own, but they were practically in growth. Anytime the dividends are that high in a particular portfolio that's primarily made up of mutual funds, that tells me right out of the gate that they're primarily in growth, especially when I have a financial advisor. And they did. They had about 90-something% in growth. Well, they were trying to reduce the risk, and so they thought reducing risk was being in good quality funds. And so what I showed them how to reduce the risk by using contractual instruments. So with that being said, we increased their income threefold compared to what they're getting, and not only that, not negating the stock market gains. You do that by investing with dividend paying stocks. Therefore, you get growth and income. But income is the priority. 5% is the priority, not the 8 to go for the 2 in the bush. So with that being said, we've came up to the end of our show, and we appreciate you all listening today. We hope that this show has been beneficial, why 5% is still better than 8%. And I want to extend this offer one more time, that if you want to know more about income first methods, then we got a book with your name on it. Call our 800 number at 888-930-1080. Again, that's 888-930-1080. And we'll get this book out to you. Again, this is the Retirement Income Shift, How to Get the Most Mileage Out of Your Money. Again, that number is 888-930-1080. And you can get this book free if you're one of the first 5 callers, free, no obligation book. You have been tuned in to the Retirement Income Source for this past hour, and we look forward to next week for some more great information. We hope you benefited from it. Stay safe out there during these cold winter months, and thank you for listening.